Chapter 9 deals with adjusting entries. Remember, the purpose of adjusting entries is to bring year-end balances up to date before the financial statements are produced. We're going to begin with the trial balance and then determine our adjustments based on some additional information that'll be given. So make sure that you kind of know what's going on in this sample company, because you're going to have to repeat these entries in your case and also in your comprehensive problem at the end. Okay, so the first thing we're asked to do is pull a trial balance. So I'll go to Reports, type in the name of the report. Okay, and then we are to change the date. Your textbook says from 10/1/2019 to 10/31/2019, but it needs to be 10/1/2020 to 10/31/2020. Okay, if you put in 2019, you won't get anything in your report. Okay, so now we have our report. We're going to now enter our first journal entry. So this is an adjusting journal entry, but they all go in the journal entry section. So we click New and Journal Entry. So it says type the last day of the previous month into the journal date. Okay, so we're going to enter 10/31/2020. In the additional information we have, it says that $500 of supplies were recorded as a miscellaneous expense, but should have been deferred as a supplies asset until consumed in future periods. So in other words, it sounds like we expensed some supplies instead of listing them as an asset. So we need to move those supplies out of the miscellaneous expense account into the supplies asset account. So to do that, we're going to click in our account column, and we need to add the account supplies asset. So I'm going to type in supplies asset, and QuickBooks knows that that is not an account, so they're asking if we want to add that account. So click yes, and it takes us over to where we enter a new account, whereas we typically would have had to go over to the chart of accounts. So this is supplies asset is an other current asset, and we're told to put in prepaid expenses as the detail type, and the name is correct, supplies asset. So we'll save and close, and we're going to debit that for $500 because remember, we're moving it out of the miscellaneous expense account. So we're going to credit miscellaneous expense, for the $500 to move it out of that account. Remember, assets are increased with debits and decreased with credits. Same thing for expenses. Miscellaneous expense is increased with a debit and decreased with a credit. This journal entry is an example of a deferred expense. So deferred just means to put off. So we are putting off the expense for these supplies until they're actually used up. Even though we've already paid for them, we're going to defer the expense until a later date. The next adjusting entry will probably be more familiar to you. This is the recording of the supplies that were actually consumed during the period. So we're given some additional information that says that $100 of the supplies assets were consumed in the month of October, leaving $400. We're trying to accomplish two things with our adjustment. The first thing is to record $100 in the supplies expense account for the supplies that we used up. And then we also need to bring down the $500 balance that was in supplies assets to $400. And we're going to do that by debiting an account called supplies expense. The account should already be in our chart of accounts. I think we added it earlier. There it is. It's called supplies, but we know it's an expense account because it tells us right here. And then we are putting $100 in that expense account to represent the $100 that we used up in supplies. Remember, your adjustment is typically for the amount used up. And then we're going to credit the supplies asset account. I'll tell you what, I'm just going to type it in instead of searching for it. And what this will do is reduce the $500 debit balance down to a $400 debit balance. So we'll save and close this time. And we want to take a look at our trial balance. So let's go back to reports and look at our trial balance. We want to confirm that our balances are correct. And I'm going to save my customization there so that I don't have to type in those dates again. Okay, so here's our supplies asset account, and it's showing $400, which is the correct balance. Because of the $500 we purchased, we only have $400 left. And down in supplies, we're showing an expense of $100. Okay, so the next journal entry we'll look at is for accrued liabilities. Remember, the matching concept says that an expense should be matched in the period in which it was incurred. So we have information that says a bill for $300 was received and recorded in the next month for advertising consumed in the current month. So we're working in the month of October, and a bill was received in November for advertising, but it should have been recorded in the month of October when the advertising was used. So we're going to add the account advertising and put in $300 for the amount of the advertising. And now we're going to add a new account called accrued liabilities. Okay, and we're going to, does not exist in our chart of accounts, so we're going to add it. And it is an other current liability. And we'll just detail type as other current liability. And the name is correct there. So we'll save and close, and we'll enter $300 there. So this entry increases our advertising expense for the month of October, and then it also increases our liabilities because at the end of October we had not even received the bill. So we didn't receive the bill until November, so we're going to enter that as an accrued liability. So we'll save and close, and we'll go back to our trial balance, and now we'll see we've got an additional liability here over on the credit side, and we should have some additional expense. Advertising expense was increased by $300. Our next journal entry is for unearned revenue. You may or may not have seen this journal entry before. It was covered in Accounting 2, so there's a possibility that you may not have seen this one before, but it's a pretty simple concept. Unearned revenue is revenue we have received that we have not performed the service for. So we have information that says design income recorded on sales receipt 1003 for $337.50 to Dylan Sawfrank was never performed, even though the cash had been received. So when you receive revenue in cash and you have not performed that service for that revenue, you cannot put that in your revenue account yet. It goes into a liability account called unearned revenue. So if for some reason the service is never performed, you would have to refund that revenue to that particular customer. So we're going to, first of all, reduce our design income, because originally this was deposited in the bank and listed as design income, and we need to reduce that with the debit. Remember, revenue accounts have a normal credit balance, so if we need to bring that balance down, we have to debit it. You know, if you have a weakness in your debit and credit knowledge, QuickBooks Online will bring it out pretty quickly, because you do have to have some accounting background to work in QuickBooks Online. The desktop version is a little bit more user-friendly for people who do not have an accounting background or training, but QuickBooks Online definitely requires that. Okay, so we've reduced our design income, and now we need to enter our unearned revenue account, and that's a new account. So we're going to add that. It is an other current liability. So we'll save that. So notice now that we have an additional liability here for $337.50 in the unearned revenue, and then the design income would have been reduced by that amount. Okay, now we're going to accrue revenue. It says further investigation of the trial balance indicates that some landscaping services of $500 were performed on the last day of the month for Diego Rodriguez, but not invoiced to the customer or recorded in the accounting records. Okay, so just like expenses, revenues need to be recorded in the period where they were earned. So we have got to come in and make an adjustment for that $500 that was not invoiced during the month of October, even though we earned it in October. So we'll go back to our journal entry, and we're going to add a new account called Accrued Receivable. This account is really similar to accounts receivable. We're going to classify it as an other current asset. Since this account is like accounts receivable, we're going to increase it, since it is an asset, with a debit, and anything related to accounts receivable, we have to indicate who the customer is that owes us the money. So in this case it was Diego Rodriguez, and then we're going to increase our income here. That's called landscape. There we go. Landscaping services for $500. Okay, we'll save and close. Our last adjusting entry is for depreciation expense. So if you remember that entry, remember it is a debit to depreciation expense and a credit to accumulated depreciation. So before we begin our adjustment, we want to go to the chart of accounts, and we're just going to modify the name of our account a little bit. So first we'll go to the depreciation account under truck. That's really accumulated depreciation, so we are going to edit it to say that, so that it's not confused with another account. So accumulated depreciation. So just change the name is all. And then we're going to go down to depreciation down here, and we're just going to add expense to the end of it. So here's depreciation. We're going to edit that so it will read depreciation expense. Okay, and now we won't get those mixed up. And that would be a good idea for you to do in your case problems also. It's just up to you. So now let's go into our journal entry. And our depreciation for the truck is $1,000. So we don't have to calculate anything. We're just going to put in the entry. So the debit is to the expense, depreciation expense. Okay, and that was for $1,000. And then the credit goes to accumulated depreciation truck for $1,000. Okay, so let's go back to the reports and take a look at how that looks on our, let's look at the balance sheet. And we'll run that for 10/31/2020. We'll run the report. Okay, so down here under our fixed assets, you'll see truck is really the heading for the account, the main account, and then you've got two sub-accounts. You've got the original cost for the truck. We know that truck was $13,495, and we have depreciated at $1,000. So now the book value for the truck is $12,495. So when you finish in your case with your depreciation journal entries, this is what your balance sheet should look like.